Is real estate investing only for rich people? No, it's not. In the last video, when we talked about buying a house in San Francisco, we basically said, if you had $200,000 to put down as a down payment, could you do better? Could you invest the $200,000 elsewhere in the country? Yes, you can. Well, what rich people like to do is they like to invest their money in hedge funds. This is typically much better than your 401k or average investment. So rich people like Warren Buffett generally get around 10 to 15% returns on their investment, on average across the last 10 years. Now, can you do this if you're the average Joe? If you only have like $30,000? Yeah, you can. In fact, we're going to try to match those numbers. We're going to try to get up to 10 to 15%. I'm going to share my own experience doing this in Northern Virginia. Straight out of school, first job, working for a nonprofit. But first, we're going to do deal analysis on paper to understand all the major pieces of the things that make real estate investment profitable for you. And one thing that you can't get away from is that you're going to need intimate knowledge of the neighborhood that you're investing in. So either you live there, or you have friends, close friends, or family members that live there that you could work with closely to find good deals. Yeah, failing that, you could use real estate agents. I started reading this book. Apparently a lot of professional investors have started to find these deals using real estate agents. The book's called Long Distance Real Estate Investment. You guys can borrow it when I'm done with it. Or you can just click the link below if you want to get your own copy. The first thing we're going to do in this analysis is we're going to Google for best and worst cities to invest in. So this article by Yahoo is pretty helpful. They list 20 of the best and worst. And the winner here is Arlington, Texas. They've based this on some pretty important factors here that I tend to agree with, which is how fast is the city growing, the trajectory of jobs being created, are the real estate prices appreciating. I have created a spreadsheet of a whole bunch of properties in Arlington, Texas that are sort of not bad, but the ones that stand out are the ones that satisfy the 1% rule. And today we are going to examine one of them as an example. So this one here, most of the information is pulled from Zillow. The thing that we're interested in is this rent to sale price ratio. And very simply, the way that's calculated is you would take the rental meter, which is a website that shows you an estimate of the rental price, divided by the sales price as listed on Zillow. Now, you should also check out the Zillow estimate and then validate both results with the actual rental price that people are listing their properties for on Craigslist. But ballpark, this seems to be correct, and we're getting over 1%. So the remainder of this video is we're going to explain how does this 1% rule translate into real income for you. Also, we're assuming that we're taking the 30-year loan. It's a fixed rate loan. That way you're minimizing your monthly payments. So without further ado, let's get into the ROI, meaning your return on investment. And the way that is calculated is your yearly profit divided by your initial down payment. So the first thing that we're going to want to know is your expenses. We're going to want to know, so your expenses is expenses. So expenses are a function of your mortgage plus the homeowners association fee plus the real estate tax every month, which is your total per year over 12. And all of that information is available from the Zillow mortgage calculator. I've plugged it in for our convenience here. To quickly walk through this, there's a home price, there's a down payment of 20%, which is standard, 30-year loan, 375, which is a pretty typical rate. So this is the monthly payment that you would, in theory, be paying. And I actually can see the property tax from Zillow, so I'm gonna plug this in manually. So we're gonna take this 535 number. We're gonna add homeowners association fee, which is $0 in this case, and then we're going to take the property tax for this property and we're going to divide by 12. So the result you get is $621. Now that is your total expense per month. So then with that number we can now actually figure out how much you're going to be able to make out of this property per month, because we're going to take the expense and we're going to subtract that from the total rent, right? And this is where, if you remember the column here, we're going to plug in this number from rental meter. And so let's see what we get. Rent price minus the expense here gives us a total of $751. That means every month we're going to get $751 back as just pure profit. So if that's it for a month, you can extrapolate to a year. You simply just multiply it by 12, and the number that we get here is every year we're going to get just a little bit over $9,000. And finally, with all these numbers armed with all these numbers in hand, we can finally calculate the final return on investment, which is simply your yearly profit here divided by the down payment, right? As we stated earlier. To be clear, this means every single year you're going to make some percentage, this is a ratio, some percentage of the money that you put in initially. And what is that? So let's see here. So 9,000, this is your yearly profit divided by the down payment, which is the total sale price of the house times 0.2%. That actually comes out to about 0.34. Or if you multiply by 100 to get a percentage, it's going to be 34%. 34% is oftentimes higher than 15%. So this already is quite encouraging. Like this here, on paper, looks like it's going to be a lot more profitable than your typical even hedge fund investment, right? Cool. But there's a little more to it than that. If you look at the age of this house, unfortunately, this house is 50 years old. So you're going to have to put in some work. You're going to fix it up so that somebody can actually live in it. So let's run through that real quick. So assuming these cost factors here, so the age of the house is 50 years old, and if we put another $30,000 into this place, besides the down payment of, what was it, $26.4 thousand. So conservatively assuming that we're doubling our cost here, and you can do a lot with $30,000, we're still looking at a return of 16%. Which is still quite high, if you recall. It's still within the range of the hedge fund targets. As I mentioned earlier, you should never invest in a place without local knowledge, intimate local knowledge of the job market there. Even though there may be a lot of employment this year, and on paper, Yahoo Finance says it's going up, but it may not be forever, right? So do your homework, and then also pay attention to the rental demand, like how long are these ads sticking on Craigslist before they get rented. This book I'm reading is really helpful. It's called Long Distance Real Estate Investing. Essentially, try to manage a place, purchase a place, and rent it out without even physically being there. Which I've not yet figured out how to do, but as soon as I do, I'll share everything I've learned. In the meantime, check out our sponsor, Albee Pizza Co. They are awesome, so check them out. Stay sexy.